For a while, I've been talking about the economy and how weak things have been, and stubbornly, the market held up for quite some time. I had discussed that the Fed, if they raised interest rates, would be making a huge mistake, that they would be doing that into a slowing both domestic and global economy, and that they really should be careful what they wish for. And I believe the Fed was sort of wishing for higher inflation numbers that they were going to kind of get ahead of. And they wound up having the exact opposite. We wound up having deflation, and that's been very evident with what's going on with crude, copper, basically any commodity you can name other than gold recently has been in very steep decline. Going through some of the economic numbers, the jobs numbers, I've discussed quite extensively that I believe them to be very weak and BS, frankly. A lot of the jobs are temporary hires. Hasn't been very much wage growth in the U.S. economy in quite some time, and whenever it is, it's like these like 0.1 incremental bumps, which is a joke. And I think the argument that the quote-unquote experts have been making is that we're no longer a manufacturing economy like we were around World War II, that we're now, a service industry. The only problem with that is that the service numbers, the service ISMs, and today, more importantly, the service PMI, have been rather weak. Today, for the first time in 2 years, the service PMI was contractionary. Anything below 50 is contractionary, and contractionary is code word for recessionary. So there is a potential here for the first quarter to have some negative growth. We'll have to see how that goes, how that plays. The Atlanta Fed, with their measure of GDP, that's really the one you want to follow. If you're not, that is it. They have been all over the place. They've been 1.1%, they've been 2.2%, they've been 0.7%. Basically, they are kind of little Mexican jumping beans, if you will, jumping around in between a small range. The problem is that, as you would think, a jumping bean can't jump very high, and we are at stall speed growth. Even if it is 2%, that is a very vulnerable amount of growth. It's not like a more robust rate of growth around 4, 5, 6, 7%. We are at, granted, we're a industrialized economy, and we're, not growing as nearly, what we were back when the country was first founding, but the 2% recovery out of a recession is the lowest, I believe, in modern history, certainly any history that I'm aware of. And it's very vulnerable to shocks and setbacks. If you don't have a very big base, any small decline is a big problem. So we've had fairly weak, like I said, the manufacturing PMI today. The service PMI today was terrible. Durable goods have been pretty junky. We all know that Boeing isn't using they cut their 747 production in half for basically their transport planes, meaning that less goods are being shipped. We know autos haven't been able to get themselves arrested, even with lower gas prices. And housing has come under some trouble. The numbers today were a little bit weak, that they were some of the weakest refis for mortgages in quite some time, and that's with record low interest rates. That just means there is no demand for the money. That's really why we have such low interest rates, because there's low, granted the lending standards are higher than they were in 2007. They're not doing the ninja loans, thank God. But the demand for money is very low, and that is a symptom of a weak economy. So that covers pretty much, I kind of backdoored you guys into my Fed keys, and that's really what I look at. But let's talk about the market keys, shall we? First and foremost, I like to talk about the VIX. And the VIX is just the fear gauge, really. It's just the amount of people are willing to pay for options. I don't want to repeat it here just to save time, but and it's also, I guess, a tease and plug for my weekend review video. I usually start my videos out with off the top with these keys, and you will be able to see how I bracket the volatility. There's a little key there. I would suggest watching it. If you're watching this on YouTube, the next video is the one that you should be watching, the one behind this one. So let's talk about the VIX. So VIX, I've stated, has been, unfortunately, for people who are long, or I should say long stocks, is making higher lows and higher highs. However, off the I drew in a channel, and off the upper part of the channel we now have a bit of a lower high and a smidgen of a lower low, but we are above some important levels. The last 2 days, I believe 2 sessions ago, we had a close under 20, which was very significant because anything really 20 and above is more of an elevated VIX. So that turned out to be a bit of a look below and fail, and then today we rallied up. We got back up to like the 20 MA. I said that 22s were going to be key. If the bears were able to push the market lower and able to get the VIX up through 22, we would probably have seen 25 quickly, but it was good that 22s failed. Basically, we tested 1920, got back up into the 22s, that failed, and we closed back at 20. So if the bulls really do have kind of a rally in their bones, they should be able to crack 20 here and take the market significantly higher. The next point of interest to me that I have marked off would be like the 1785-ish area. That has been basically in the 17s, mid to high 17s. So we'll have to see how that plays out. If I would say today's high of day is taken out in the VIX, we're going to probably see continued correction in the market. If they take out the low of day and they push it through 20, then I think we're going to see the 17s and 18s, and the rally will continue. The big problem that I've been discussing is the dollar, and I think a lot of that has to do with obviously the Fed policy. They're the one tightening as the rest of the world is weakening. Japan went negative with their interest rates. Europe has been still doing QE programs, and there's been a bit of fear going on, in my opinion, with this whole will they or won't they with regard to England leaving the Eurozone. Now, England still uses the pound. They're not on the euro, but I would imagine that would create some instability in Euroland. So the good news about the dollar is that it's starting to make lower highs and lower lows on the swing here. The bad news is that it's still too high. It's too high for comfort. I have been talking about the UUP because a lot of people, I don't think a lot of people trade the dollar futures. I don't know how many of you guys trade DX, but I know some people are interested in ETFs. We're all about ETFs these days anyway. That's kind of like the new norm. So UUP, I've drawn in some levels, and we're still above an important one, the 25-23. We've been roughly holding the 200 MA. Today we had the potential for an outside day. We were up high and then low. It's looking very volatile here. We're going to have to see anything above 25-23 to me is still risky to the upside. But as long as it's contained below 25.68, I mean, we're talking, in currency, it's sometimes a matter of even within the strike. Like sometimes I generalize and I say 25s and 26s. This happens to be very nuanced with regard to the UUP because it is currency. So anything above 25.23 to me still has a risk to the upside, but below 25.68 is still like kind of okay. And when we've gotten down below near the 24.47 area, that has been kind of the support. So we're going sideways. It's building up pressure. There is a lot of risk to the upside. I'll tell you, if they can get the dollar, and I'm going to flip back to DX for a minute because that's what this really keys off of. The dollar has been hovering really and playing kind of footsie with this 100 level. The risk is if they get it through 100, there's not much to stop it there until like 105, 106. And I assure you, you will not want to be long stocks if that happens because the market will be in free fall. Why is that? Because oil is priced in dollars, and as oil goes down, the market goes down. And if the dollar is rising, it is likely that oil will be going lower. Speaking of oil, although I usually do the bonds first, but since we're talking oil, let's keep it simple. We'll stick to the oil. I use the continuous contract, the CL, the /CL. I like it better than the USO. We had the contract flip the other day. There was a bit of a spike. It's kind of given it up. It filled the gap, so to speak. but we are still above where that gap was, even with the weakness. Today we filled the gap. We tested below the 20 MA, but we're able to hold it. So we're sandwiched here between the 20 and the 50. The good news is that the 20, for the first time in a long time, is now upwardly sloping. Why does that matter? When moving averages are downward sloping, that means that the average of the prices is lower. Now it's starting to bend back up, and this is an early signal that could be the sign of a potential trend change. I've been saying for a while that I think oil is trying to bottom. They certainly are not making it easy. It's very choppy down here, although when markets or commodities get very choppy at a top or a bottom of a range, it usually could be the top or the bottom of a range, and this might be the bottom of the range here. We are below the 33.20, which is the 2009 crash low. Believe it or not, that's how bad things have gotten here with oil. And as long as we're below there and below the 50, it is still vulnerable to lower. I will grant everybody that. However, we did hold the 26 level, and I had said I thought 25, 26 a while back would be the low after we broke the after we broke the 33.20. So that turned out to be okay. I will say this. If you're playing oil, I would be very cautious. You have a really good reference low today. If you're long, you could use that as a stop. I would like to see some moving average convergence and divergence type of action here. The last time when the 20 crossed through the 50 was kind of a big deal. That was back in November. So maybe here we're going to see the 20 cross through the 50 and start getting some confirmation that we're putting in a bit of a bottom. I've been playing this mostly with selling puts in oil stocks when they dump, and I've been playing the range. I like Exxon and Chevron because I don't think I'm going to wake up to these things being down huge one day, meaning they could be down, but they're, could be down within the context of a range. So I also believe that these are the strongest of the batch, and I think that they will be the last of the Boy Scouts if any of them have to cut their dividends. We broke out of the 200 MA I'm just looking at Exxon. We're a little overbought on the stochastics, and we got up to the 83s, which was a bit of a top of the range. Today we actually had a gap down. We held the 200, which was really, really significant. So if you're long Exxon, I think you can play it off of that. I was actually thinking we could maybe see the 50 MA again. So you're talking within a couple of bucks now. The 50 has come up quite a bit, which is also upwardly sloping. You have a 50, 100, and a 200 MA, and now, I'm sorry, that was not correct. You have a upward sloping 20, 50, 100, and the 200 MA is starting to flatten out, which is a good sign. This is confirmation of what I was talking about with oil. And Exxon is the Mac Daddy of them all. So if they're going to turn, it's going to be starting there. Exxon isn't overstretched with their balance sheet with debt. That would be like I said, the last of them to go. So I believe in buying Exxon, playing the dips in Exxon. I put on today a put ratio. Do I have it on in Exxon? I did one. I did it in Exxon today. I did a 75, 72. This is a little. I think I may have made a mistake filling this. I did 23 days. It's a little bit more than I normally go, but whatever. I don't mind owning Exxon down at 72. So 75, 72. That range I like as a long. The range here may have moved up now since we have the upwardly sloping moving averages. 78 looks like it's the 50 MA, so I would say around there is a good row area. So I like selling puts in Exxon on dumps. Like this morning was a good opportunity, and I wound up doing that, but I did it playing for potentially for a bit more of a down move. A put ratio, for those that don't know, means you buy one of the higher strike and then 2 or 3 or however many times of the lower strike. So technically it's net short of premium. That's why I do those into declining moves. You don't want to do them when they're rallying. You need the IV to be high so that you can get width in terms of your strikes. What does row mean? It just means right or right out, meaning you put in a trade, you have a technical level you're playing against, and either you are right or you are right out of the trade. And then the counterpart of row is GTFO, meaning get the F out. And yes, F. When I say F, I mean F. So that's the deal with that. Let's move on here to the bonds. So for those of you who have watched my video, well, we talked about the strikes with Exxon. I said I did the 75, 72, although I like, I really anywhere between now, maybe 78 you could use. Anything below there, it really shouldn't get below there. I could do a video maybe on put ratios. It's a little bit nuanced. It would take a little bit of time to kind of, like, I know what I'm doing. It's automatic in my head, but I'd have to really kind of walk through it, kind of do a put ratios for dummies, so to speak, or put ratios for beginners. We could talk about it. I'll definitely consider it. I'll talk a little bit about it here. I'll do a little bit of a teaser here, maybe put ratio 101 light. So there's a lot of interest in this. I happen to love these plays. It's basically what I do with the put ratio is when I'm kind of bullish on something, but I think it's going to go down short term, I want to catch some of that down move and then get long at a lower price. So let's say, for an example, with Exxon in this case, this could potentially go out worthless, although it's a lot of days. That's why I went further out. Usually I'll go further if I'm going longer. But in this instance, I would be playing for a move down to 75. Really, up to 72 is okay. But assuming Exxon came down to 75, that 75 put would gain value, as would the 72s, of course. But the goal is to make money on that long put, and then get long the stock, or basically say it's not going to go past that lower strike. The real risk you run is if you do it too close and you get your price knifed through, meaning the lower strike gets cut through. Like, for example, if Exxon went to below 72 by more than the width of the strikes minus the half of it. We're really going to have to do a video on that. I'm going to have to do some charts with some graphics for this, but keep in mind that your risk is if you knife through the lower strike significantly. More than your break-even price. When you enter the trade into, like, let's say think or swim, for example, it'll give you what your break-even numbers are. So anything below that, you're in trouble. I usually pick them around moving averages or trend lines or Fibonacci retracements. I have a technical grounding for doing them. I don't just say, I want $3 in Exxon and I want to do it around, around this price. It's because it was a reference level, a Fibonacci level, a moving average. There's always some method behind the madness. So that's the deal with the put ratio. It's on stocks that I don't mind owning long, lower, but I do think they're going lower short term. Like, there's going to be a bit of a move down. I capture that move, and then I can either reverse and go long, or sometimes I just close out the ratio. Sometimes it works out that way. In general, I like to do them the same week or the next week, maybe 2 weeks at the max. That's sort of my MO on that, because you can adjust them if you get into trouble. Like, if you're a month or two out, or 50 days out, you're going to have to roll or do some kind of adjustment, and you could be, out past 6 months, and who knows what's going on, and, who knows what's going on in a few, I'll tell you, the market is so nuts these days. Who knows what's going on in 5 minutes or 5 days from now? Nonetheless, 5 weeks or months. I mean, it's a little bit of a fool's errand, I think, to go too far out. I think that was a mistake that I would say that I made when I was younger. I think I used to basically, I wasn't as mindful of price, and I'd always be selling a lot of premium, and it would sometimes be a little bit too long. I'd rather be closer in terms of my strikes with less time on the clock than longer in my strikes with more time on the clock, if that makes sense. I know it's a little bit scary, but I assure you it is the better strategy. You can adjust it if you get into trouble a lot quicker. Like, if you have options that are expiring, first of all, the theta decays very quickly. That's the time value of an option. There's an intrinsic value, which is just where it is in terms of price, and then also a time value. That value decays quicker as you get closer to expiration. So if you have options expiring the same week, or if they're expiring the following week, that decay gets exponentially quicker. If you're longer term in the option, you're 50 days out, it doesn't decay so quickly, and you also usually have a higher delta exposure. I don't want to get too much into this, But basically, if the price goes against you, you're in a lot more trouble than you would be if it's shorter term, because you could always take those options that are short term and roll them out to lower strikes further out, and the premium there will make up for the loss. I probably will have to, if I do this, what I'd really have to do, I think, is set up a demo account. I just trade in a cash account. I'd have to set up probably a paper account and do some examples of these to really explain it properly. It might be a more of a webinar type of a thing. I have to talk to some people about that, but we could probably make this happen. Anyway, let's table that for a moment. Let's get into the bonds. I hope that helped. I hope I didn't confuse people more than I explained. But options, it's funny when you talk to people that you trade options, they think it's so risky. But the truth is that they're not that risky if you use them smartly. And I'll tell you, here's a question. I always ask this of people, and I'll tell you the answer afterward, but I'd be curious. I should really have done a poll on this and just seen what people said. But I always like to ask people why they use options. What's your reason for using options? And the common answer is that they use it for leverage. They usually are people with smaller accounts, and they can't afford Priceline at 1,000 or 1,500, whatever the hell it's trading at. So they will buy options, and they'll they'll buy calls, or they'll buy puts, or they'll do spreads, and they'll usually do them in a larger number. The truth is that's, yes, playing directionally is okay, but the truth is that using leverage isn't really the true benefit of using options. The benefit of using options is to increase your probability of success. You're willing to limit your returns, but you're willing to increase your probability of success. And in the end, that is really what matters. Like when you're selling premium puts or whatever, you can only make the amount of the premium, but the probability of that trade working, as opposed to just buying a stock in hopes it goes up a point or two, it's better if you're selling, like, let's say, puts $10 out of the money and getting paid for that. If the stock never goes there, or if it even just goes close, you still are a winner. It just increases your probability of success, and that's really the name of the game here. It's to have consistent, steady winners. The people I know who lose money in the market, yes, it's a game of inches, that's correct. A lot of people I know who lose money in the market have more of a gambler's mentality. They're the kind of ones who go for like the long odds. They are looking to always swing for the fences. And the truth is that you're always maxed out in your account, meaning you're at max margin. There's always a probability, and it could be even up to as much as 30%, believe it or not, that you'll blow out your account at any given point in time. I know when I was younger, I'd always have to be fully invested. I'd always want to be, I used to call it, I used to use not such a colorful term for it, but it was basically a maxed out margin. And I would always see that I would be missing opportunity and missing the maximum of that opportunity. But the truth is that if the market goes against you, what's known as the geometric series can go both ways. And markets tend to go, when they go wrong, they tend to go wrong against you quickly. And usually larger than you would when they're going your direction, the right side, because you have a lot of other people who are on the wrong side of the trade as well. So the geometrics, like I said, the geometric series will work exponentially both ways. It'll amplify your returns, but it'll also amplify your losses. And usually people who have smaller accounts have a margin requirements. And if you blow through those, you're basically pretty screwed. So that's my take on that. Listen, you could have a large account and do the same thing and blow yourself up even more spectacularly. But my advice would be is just when you are managing your risk, and I created a great video on this. I don't know if you've all seen it. If you haven't, I really highly suggest watching it. It's called Risk Management 101, the 10 Risk Management Commandments. And I'll tell you, those are lessons that I've learned over the years of trading. I've been trading since I'm a teenager. Older now than I care to admit, but I assure you that those lessons have been learned over time. Some of them, unfortunately, the hard way, and some of them I benefited from seeing other people learn the hard way. Misery loves company. But I will say this, that if you follow those rules, you will be a much more successful trader than you probably ever would be without them. So that's my 2 cents on that. Someone asked me, what would I consider a smaller account? I mean, I think that years ago, it's funny, back in the .com days, to have a margin account, you had to have 10,000, and now I think it's like 30,000. But honestly, I think if you're playing with lower than, more than 6 figures in the account, it's probably a bit of a smaller account, particularly with these momentum stocks these days. If you're selling puts in Google, or you're doing this in Priceline, 30,000 could go pretty quickly. All right, so that's that. Let me get into the bonds here. So I know I talked about this a little bit in the weekend review video, and I'm going to talk about it a little bit more here. The stocks are valued on what's known as a discounted cash flow basis. If you don't have time, I would go to Google and type in DCF valuation, or go to YouTube. I'm sure there's some introductory videos on those, and you'll see that there's something known as a discount rate. I don't want to get too into how to calculate that discount rate. The correct one to use is what's known as the weighted average cost of capital, also known as WACC. But part of that component is the risk-free rate, which is the bond rate, and that goes into the denominator. There's a numerator and a denominator. All you really have to know about this is the keep it simple stupid method, is that when interest rates are higher, that denominator, the bottom number, goes higher. If you're dividing a number by a bigger number, your end product will be smaller. If you're dividing a number by a lower number, meaning a lower interest rate, your end number will be bigger, and that is your stock price. So, multiples, the multiple that people are willing to pay for a stock, go up when interest rates go down and go down when interest rates go up. Why? Because the ability for them to have return is challenged more when that interest rate goes higher. They can put their money into less risky assets like bonds. When bonds and treasuries get up to 5 and 6% yields, that's usually when major inflection points in the market happen. That's what happened in 2000 and 2007. If you're able to put your money into a treasury for 5 or 6% and just sit back and relax, why are you going to risk it in the market as much? Or you'll allocate less to the market. It's your bond equivalent yields become less attractive. Anyway, I hope I explained that well. I really want to keep this very simple here. I don't have any graphics to show people. I really want to keep it simple. The problem here is this. When interest rates go down fast, meaning bonds spike, people get worried about recession. It's sort of how you get there. It's not so much where you are, it's how you get there. That's not good. I had a call coming in. All right. So anyway, hopefully that will end in a little bit. I apologize. Anyway, the problem we have here is that interest rates have been on a huge tear. They've been on a huge, bonds have been on a huge spike. And you've had interest rates go down a little too rapidly. People think that there's something wrong because there's a healthy level. In 2009, for example, we're going to talk about the TLT for a moment. The TLT got up to 123.15, and keep in mind this was like the end of the world. Even today, with a bit of a pullback, TLT is 131.21. That is a recessionary number. It's because when people get fearful of the market or of their prospects in the economy, they don't worry so much about a return on their capital, meaning investing and making money on their capital. They worry about a return of their actual physical capital. I believe a few reasons why that the treasuries are going here. We knew QE for a while was the reason. The Fed was buying bonds and they were distorting the market, and that kept the underlying bid under bonds. Was known as the Bernanke put or the Yellen put. When a lot of people talk about that when they discuss it, they think it really refers to equities, but in my mind, it really refers to the bonds. Anyway, with regard to that, the reason I think that treasuries are as strong as they are is for a few reasons. One is you have melting down global economies, and these countries don't have banking systems like the United States. They don't have FDIC insurance. So very wealthy people need places to store their money, and they don't want to put them in a bank like in Greece and wake up and the bank is closed, or there's some type of a run and they can't get their money out. So what do? They buy dollars. That's why the dollar has been strong, and then they buy bonds, and that's why bonds have been strong. They are federally insured, and they are in the United States, and they are now benefiting from an increase in bond prices as well as an increase in currency prices, which is like a double whammy. That's like an amazing return. But it's also a liquid market that they know it's not an exotic instrument, that if they have to sell treasuries, you can basically just hit the bid and be out and not take much of a price loss. This is what wealthy people think about. They don't think about, catching the last penny in Apple. They think about moving millions of dollars in and out of bonds. And believe it or not, as interest rates go higher and bond prices come down, people tend to actually buy more. It's a little counterintuitive, but that is really how it works. Anyhow, the good news for the stock market, though, is that the PE multiple will be sustained to some point because of the low interest rates. I've speculated and stipulated that as long as we have these subnormal interest rates, we will have a higher than normal PE multiple than the market would normally provide. And that's really the story here. That's why the equities have stayed up for a few years. I also have stipulated that, and I put this out on Twitter today, that the average return in the stock market, and this is starting to get a little controversial when you factor in crashes, is roughly about 10% over time. You had a 30% move in 2013, so it makes sense that the last 3 years have been working off that excess. That's really what's been happening here. You took 3 years because of QE and you put it into one, and when they stopped doing the bond buying, you basically have just been working off that excess. It sort of was like you got paid up front and now you're kind of sitting through it. That's the story. So bonds, that's why they're strong. The last component of this is that the other bonds, the riskier bonds for people to put their money into, have been stressed. When there is stress in the credit system, like in the high yield or in the junk, they do what's known as the flight to quality, and the best quality is U.S. Treasuries, and that's a fact globally. U.S. Treasuries are the gold standard for bonds. It's funny. S&P did their little downgrade a few years ago or what have you, but that means nothing. The truth is that the bonds did nothing but rally after that because the food chain down the chain wound up being downgraded more than the U.S. I don't want to get into that too much here. That's a little bit more of a advanced topic. But if you kind of debase or you lower the credit rating on the best, the others get it with multiples below, and I think a lot of that actually is factored into the system. Banks. Let's talk about banks. We're talking about. I'm going rogue here a little bit. Normally I would talk about China and biotech, but we're going to kind of get there a little bit more backdoored. We're doing it a little bit differently this time. It's not always fun to do it the same way. Let's talk about the financials for a minute. Now, there's a lot of fear in the financials for a few reasons. One is that they have derivative books or loan books. That's particularly in Europe. There's concern about the European books. But the concern in the U.S. is counterparty risk, how much exposure they have to those European banks, and how many loans do they have that are to energy companies that are contingent upon profitability with higher oil prices. As you know, oil prices have come down, so the ability of these companies to pay dividends or to make good on debt, and a lot of them have debt, becomes more risky. So it's sort of a game. I think everyone, traders tend to fight the last financial crisis, and everyone automatically in their minds jump to the mortgage crisis. I don't believe there are derivatives on derivatives with, the world land of make-believe of financial engineering here. I think there's just a certain amount of loans that are going to go bad, and I think that traders are a little bit, when in doubt. There's an old saying in the pits, and it's when in doubt, palms out, meaning sell, and I believe that that's been part of it. So it's a combination of the fear of European bank counterparty risk, bad loan risk, and also the fact that these companies have been neutered in terms of their ability to make profits, meaning that their financial regulations have been so strong that they can't make money like they used to, and they are dependent on a steep yield curve. And we just talked about how bonds are with the lowest yield in maybe forever, that I'm really, frankly, forever, that I'm aware of. So the ability for companies or banks to borrow at the short-term rate and lend at the long-term rate, and they pocket that difference, meaning they borrow short-term and then they lend with mortgages, 10, 15, 20, whatever year mortgages, and pocket that difference, is harder because there isn't that steep of the yield curve. The yield curve is very compressed because people don't have anticipation of higher interest rates going out because they think the economy is not doing well, and there's less of a demand for money. To have those higher interest rates, you need people to want to borrow more money, and that is what's the problem. It's not happening. I just talked about the refi numbers and the loan demand. That is usually signals of economic recession. It is what it is. It's that simple. So that's really what's going on with the banks for anyone who is curious. I hope I explained that well, but it's a myriad of things. With regard to Europe and the European banks, they never really took the write-downs and the losses fully that they should have done. This is actually the mistake the Japanese made with their companies. They never took the losses, and that's why they've been in a basically zombie economy and a zombie stock market forever, for 20 years for the most part, or longer at this point, 30 years. They've been struggling. So Europe never really took their losses down. I also think that a lot of the financial regulations here in the United States, the risk of certain instruments that would normally have been spread out over a lot of banks is now compressed into a few in Europe. They don't have the same type of financial regulations that we have here, so all the business, the risky business, so to speak, and I'm not talking about the Tom Cruise kind of risky business, I'm talking about, although maybe it's kind of the same with some of the shady things that go on, has gone to Europe, to Deutsche Bank, to Credit Suisse, to UBS, and they have been taking on some of these exotic plays, and they have a big derivatives book based. All that means is that they have a lot of options in commodities that have all gone the wrong way, and the fear there, real or not, and I guess it is just because the way that Wall Street is treating these stocks, they have big write-downs coming, meaning they have big losses. They're positioned the wrong way. A lot of these companies have risk management characteristics. The problem is that they may not have factored in enough of a decline, meaning they have a certain tolerance for risk, but these have shot through them. I mean, the decline in oil is a multi-standard deviation move, and this has put a lot of these companies into a lot of trouble. So that's what's going on in Europe. I don't think the European banks are all going to go bust. I have no idea how they're going to handle this. Either the price of oil and these commodities is going to rebound soon, and they could maybe have less losses, or it's going to be time to pay the piper soon, and these companies are going to have massive write-downs, and the stocks are probably going to get pretty badly beaten up. Incidentally, I put in some orders to buy some of these stocks down around $5. Why 5? That's, I believe, the number that funds are allowed to hold these companies at. If it gets below 5, they usually don't own it. So I figure that these companies will do their best to defend the $5 level. And if I'm buying at 5, the most I can lose is 5. And if I do it small, my goal here is to buy a basket of these stocks, a few of them, betting that some of them might go bust or some of them might never recover, but the one that does will make up for all of the losses of the small buys on the other. This has been a very successful strategy for me in the past. I haven't done it in a while because we haven't had a crash in a while. This is actually, believe it or not, when I get to this type of analysis, I do some of my, I like to say some of my best work. I go through company balance sheets. I figure out what is solvent, who will be the winner. I remember the one I really kind of cut my teeth on doing this was back when I was a lot younger. I did this with Williams companies. This was after the Enron blow up. I went through El Paso. I went through Williams. I went through all of the Dynergies and all of this. And I basically looked at their ability, their assets, the quality of their assets, their ability to pay debt. There was a lot of characteristics. It's different for every industry or company. And I picked Williams at the time, and I bought it really, really cheap, and I had sold a lot of calls against it. I wound up owning the stock for free and then sold it for like $30. So I sold it way too soon. The stock went way much higher, but shortly after I did my analysis and I was long, Warren Buffett came in and bought their debt, and the company was basically saved. And that's a long time ago. But there will be, this will be the name of the game soon with some of these banks, and again with some of these energy companies. So I'm going to actually start working on that soon. Anyway, I think we covered a lot of good stuff. I'll cover IB. Let's just finish up the some of these market indices here. I mean the Fed, the market keys, and then I think we'll wrap. The FXI here. I talked the other day about it holding it basically went below the reference low. It was a look below and fell. We went back up, and now we seem to be consolidating in a range. I'm just looking at the FX. Where did we close today? It kind of had a look into the gap today and fell, and we basically held the 20 and closed up. The only thing I don't like is that the body of today's bar still closed below the prior day's range. So I would say if you want to play long this, you really have to use today's low as a stop. Otherwise, I do think that the gap will likely fill, and they'll try and retest for a bottom. It's funny with the low. It was a bit of a look. It was a bit of a look below and fail with that 28.10. 28.61 was really the reference low when the snap happened, and you fill up the triangle to that area. Basically what I mean by that, and I think I've shown this in the weekend review video, if you're curious about what that means about snapping a trend and filling up the triangle, I'm not even going to try and describe it here, but I will suggest watching my weekend review video. Either watch the one from this past, I think it's in this past week. If it's not, it will 100% be in this Sunday's video. The other risk on, risk off gauge, and this is one I think is puzzling people, is IBB. Why has IBB been down so much? And the reason is this, is every political candidate, Hillary Clinton, Bernie Sanders, and even Donald Trump, and these are the major front runners and people who are likely to win, more likely Trump and more likely Hillary, based on their polling, are both talking about negotiating down drug prices. That means that this industry may have seen peak profits. That's why they have a low PE multiple. Often when industries top, they are by definition at peak earnings, meaning they are showing the cheapest. When industries bottom, they tend to be showing a high PE multiple, and because their earnings are destroyed. At this point, I think that it's safe to say that we may have seen peak earnings in terms of these biotech stocks, and I think part of the reason for IBB's decline is that, and I also think it's because of the ETF. It becomes a self-fulfilling prophecy with the stocks. You have big stocks that are comprised in that ETF, and then the ETF itself is an asset. So what I think happens is that you have a move down in the stocks, people have to sell the ETF goes down, so people sell the stocks, and then the stocks goes down, so they sell the ETF. We've been talking about how ETFs are in vogue, and I think rather than play individual biotech stocks because of the enormous risk that biotech stocks have with approvals and stuff, have gone the safer route with the ETF, the IBB. The trade got really crowded. You have potential peak earnings, and you've come back a lot. It did, however, hold the 200-week MA, which is important. It bounced. The bounce has been a little bit light, and we're kind of coming back down again a bit. I've been looking for it to retest the 207, maybe 212 area. Believe it or not, the primary trend from the crash low is like, I don't even want to say it because it's so far down, but like 100 the 136, 137 level. If it were to happen tomorrow, I don't think that's happening. I think if it got that trend, it would take a long time, and that trend would likely move much higher. But we are below more of like secondary and tertiary trends. And we're at if you go from the pullback low to the high, we're basically roughly held the 78.6. In practical terms on a daily chart, and I'm just doing this one because I know a lot of people are involved with this, we had a bit of a gap fill today. I would say if you lose today's low, it's not good. Today's low basically retested the 20 MA, you had a gap fill. Today's range is important. If you lose that, it's trouble. If you can get back above the reversal bar of the 267.60-ish area, then I think there's a bit of a run. I was really thinking we might retest the breakdown, the hammer breakdowns in the 280s, but it seems a little bit too weak for that. I think that this is just going to be a really tough trade for a while with the politics that are happening, and it may be due for a rally. It likely is due for a rally, but I think that it probably will see lower prices at some point. Anyway, I'm going to wrap it up there. I have somewhere to be in a little bit, but I feel really good about today's broadcast. I think we set the goals that we wanted to be a little bit more qualitative than quantitative because of the inability to see the charts. I'm really curious to get your guys' feedback on this because this is very different than other videos where I've kind of gone through more stock picks. So please leave me some comments. Tweet me if you want to send me a direct message on Twitter ever. My DMs are open. Even if I don't follow you, you could send me. I really am curious to get some feedback on this and some suggestions. Anyhow, if you caught this late or you want to watch it again, we did discuss some really big concepts on here that, believe it or not, are a little bit more complicated. You probably might want to rewatch it. It is going to be on my YouTube channel in a little while. That is Justin Pulitzer Trades. If you're not following me on Twitter, my handle is @JustinPulitzer. Anyhow, this was I really enjoyed this broadcast. I hope you guys took away some useful pieces of information from this. And let's have a great rest of our trading week. Keep in mind, last bit, just because I can't resist. I'm a SPY junkie. I love the S&P. We are still above the Fed day high, which is the 191.56. We filled some gaps today. We looked below there. We filled, but we did close above there. If we get back below there, it's a little riskier. The body low of today's bar was like 190.66. If we start really getting below that dollar's worth of range, trouble. Anything above, the range high in the 194, 195, then I think we're going to see the 197s and maybe even 200. So let's keep it simple with that with SPY. Anyhow, let's have a great rest of our week, and cheers.